So hello, we were doing complete course for EPFO. We have already completed 16 chapters. This is our second last chapter. Then we'll take share capital transaction. That is going to be our 18th chapter of principles of accounting. So if you haven't watched the previous chapters, please have a look. You can go there after watching this chapter as well. At the same time, PDFs are available on the Telegram free of cost. You'll find other important study material as well on the Telegram. The name is EduAastra. At the same time, if you need any other resource, do let me know. I'll try to provide with the same. So let's start with our chapter 17, that is ratio analysis. Introduction. So ratio analysis is a quantitative technique of financial analysis used to interpret financial statement and assess a company's liquidity, profitability, efficiency, and solvency. So ratios help the examiner or management compare what current performance with past performance, that is your trend analysis, then performance with other firms, that is inter-firm comparison, then performance with industry averages, that is benchmarking. Then meaning and objective. A ratio is a mathematical relation between two interrelated accounting figures. Formula for ratio is equal to one figure divided by another related figure. You must have seen 1 by 2 is equal to 1.5 or a by b. All of this you must have seen in ratio and proportion chapter in mathematics. Then objectives of ratio analysis. क्या होता है इससे? To evaluate financial performance, to identify strengths and weaknesses, to aid in decision making and planning, to facilitate inter-firm comparison, to help in trend analysis or year-wise performance. So again, very important. If you have seen previous chapters, then you must be aware that हमने बात की थी कौन कौन से questions are very important. That is a definition, merits, demerits, pros and cons, uses, and such questions, objectives. So direct statements are there. Very easy question you will find from all of these core topics for EPFO. Types of ratios. Ratios are broadly classified into 4 categories. So what are these categories? So liquidity ratio, solvency ratio, activity or turnover ratios, and profitability ratio. Purpose: liquidity ratio, short-term financial position. Key ratios: current ratio or quick ratio. Then solvency ratio, long-term financial stability. Key ratios: debt, equity, proprietary or interest coverage. Then activity, turnover ratios, efficiency in using resources, inventory turnover, debtors turnover, creditors turnover, working capital turnover. Then profitability ratio, ability to earn profit, gross profit, net profit, operating ratio, return on capital employed, that is ROCE, return on capital employed, and EPS. Now A, liquidity ratios. हमने यहाँ ABCD देखा था, तो we'll take that in sequence. So first is A, liquidity ratios. Current ratio indicates ability to meet short-term obligation. Formula is for current ratio, current assets divided by current liabilities. ठीक है, A upon L, current assets upon current liabilities. You must be aware about the Gooden formula as well, which we have done in the previous chapters and which was there in the previous year question as well. What was it? संदीप भैया से हमने याद किया था ALC संदीप उलान, that is asset is equal to liability plus capital. Very important. Then ideal ratio to ratio 1. Interpretation: higher ratio, better short-term liquidity. Too high ratio, inefficient use of current assets. Then quick ratio, asset test ratio, so measures ability to pay current liabilities without relying on inventory. Formula: quick ratio is current assets minus inventory minus prepaid expenses divided by current liabilities. ठीक है, क्या है? करंट एसेट्स माइनस इन्वेंट्री माइनस उसमें से करेंगे जो भी प्रीपेड एक्सपेंसेस हैं, एंड देन वील डिवाइड ऑल ऑफ दैट बाय करंट लाइबिलिटीज. आइडियल रेशियो इज 1:1. Interpretation: quick ratio is less than 1 indicates liquidity issues. Then solvency ratio, debt equity ratio indicates relative proportion of shareholders funds and borrowed funds. Formula: debt equity ratio is long-term debt divided by shareholders fund. Ideal ratio 2:1. Interpretation: higher ratio, dependence on debt, more risk. Proprietary ratio shows proportion of shareholders fund to total assets. Formula: proprietary ratio is equal to shareholders fund divided by total assets. Ideal ratio is 0.5:1, that is 50% or 1/2. Then interpretation: higher ratio, higher financial stability. Interest coverage ratio indicates ability to pay interest on debt from profit. Formula: interest coverage ratio is equal to EBIT divided by interest expense. EBIT is earning before interest and taxes. ठीक है, earning before interest and taxes. Ideal ratio is more than 3 times. Interpretation higher, safer for lenders. Activity turnover ratio show efficiency in utilization of resources. Inventory turnover ratio. Formula: inventory turnover is equal to cost of goods sold, that is your COGS, divided by average inventory. Then average inventory is equal to opening plus closing stock divided by 2. Higher ratio, so faster inventory movement and efficient management. Debtors receivable turnover ratio. Formula is debtors turnover is equal to net credit sales divided by average trade debtors. Indicates efficiency in collecting receivables. Higher ratio efficient collection, lower ratio is poor collection. ठीक है, debtors receivable turnover ratio, higher ratio is efficient collection and lower ratio is poor collection. Then creditors or payables turnover ratio. Creditors turnover is net credit purchases divided by average trade creditors. Indicates frequency of payments to suppliers. Then working capital turnover ratio. Formula: working capital turnover is equal to net sales divided by working capital. Indicates efficiency of using working capital to generate sales. Then profitability ratio, gross profit ratio. Formula is gross profit ratio is equal to gross profit divided by net sales into 100. Indicates production and pricing efficiency. The net profit ratio, formula is net profit ratio is net profit divided by net sales into 100. Then indicates overall profitability after all expenses. Then operating ratio. Formula: operating ratio is equal to operating cost divided by net sales into 100. And if the ratio is lower, lower ratio is better operational efficiency. Then return on capital employed, that is ROCE. Formula for ROCE, return on capital employed, is net profit before interest and tax divided by capital employed into 100. ठीक है, what is it? Net profit before interest and tax divided by capital employed into 100. Measures overall efficiency in using long-term capital. Earnings per share, that is your EPS. Formula is EPS is equal to net profit after tax divided by number of equity shares. ठीक है, net profit after tax divided by number of equity shares. And what if it's higher? So higher EPS is higher shareholder return, उतना ही higher होगा shareholder का return. The interpretation of ratios. Current ratio more than 2 is idle funds. Current ratio less than 2 is liquidity issue. Debt equity more than 2 is high leverage. Gross profit ratio falling is cost or pricing issue. The net profit ratio rising is good cost control. Inventory turnover high is efficient inventory management. Then limitation of ratio analysis, again very important. All of things that we have seen just now, the formulas and the last line of each and every paragraph, that what if is the ratio is higher, what if is the ratio is lower, are also very important. The limitation of ratio analysis, ratios are based on historical data, do not consider price level changes, that is inflation. Then different firms use different accounting policies. Window dressing may distort ratios. Ratio alone cannot give conclusions, requires comparison and context. Then some of the previous year questions. Current ratio is equal to 2 ratio 1 means current assets are twice of current liability. ठीक है, current assets are twice of current liability. Obviously 2 ratio 1 है, मतलब this portion is double of this one. Then which ratio measures short term liquidity? Current ratio, quick ratio. Which ratio measures long term solvency? So debt equity ratio. Operating ratio plus net profit ratio is 100%. If cost of goods sold is 3 lakh, average inventory 60,000, inventory turnover is 5 times. ठीक है, क्यों 5 times? You tell me. हमने अभी भी फॉर्मूला देखा है. एंड देन ये इधर आ जाएगा, उधर जाएगा, तो उससे हो जाएगा डिवाइड, एंड व्हाट वील गेट इज दिस 4 zeros, 1 2 3 and 4 6 5 times is 30. So क्या आ गया? आंसर is 5 times. Then debt equity ratio of 1:1 means equal contribution of debt and equity. Interest coverage ratio of 4 means EBIT is 4 times interest expense. If net profit is equal to 50,000 and net sales is 5 lakh, Net profit ratio is 10%, which ratio shows management efficiency in using total resources. ROCE. What is the full form of this ROCE? We have seen just now twice. Higher debtors turnover ratio indicates efficient collection of dues. Then one practical example, current assets is 1 lakh, current liability is 50,000, inventory 20, net sales 5 lakh, gross profit 1 lakh. Then our current ratio is 1 lakh divided by 50,000. ठीक है, assets upon liability जो हमारे current में asset है upon liability is 2:1. Then quick ratio 1 lakh minus 20,000 divided by 50,000 is 1.6:1. Gross profit ratio is 1 lakh divided by 5 lakh into 100 is equal to 20%. सब formulas हमने अभी Then let's come to our flashcard, which is very important and beneficial. So at the time of exam, you can just come and revise. You'll find this PDF on the Telegram, EduAastra, as well as the other important PDFs. Current affairs, your history, economy report and indices related to other exams, as well as the important exam notifications, everything. Then ratio, what is ratio? The one accounting figure divided by another. Ideal current ratio is 2:1, ideal quick ratio is 1:1. Measures long-term solvency, debt equity ratio. Measures liquidity, current ratio. EBIT stands for earning before interest and taxes. Ideal interest coverage ratio 3 or more. Gross profit ratio formula, gross profit divided by net sales into 100. The net profit ratio formula, net profit divided by net sales into 100. Operating ratio plus net profit ratio is 100%. ROCE formula, EBIT divided by capital employed into 100. EPS formula is net profit divided by number of shares. Inventory turnover ratio is cost of goods sold divided by average inventory. Debtors turnover ratio, net credit sales divided by average debtors. Creditor turnover ratio, net creditor purchase divided by average creditors. Working capital turnover, net sales divided by working capitals. We have seen all of these formulas just few minutes back. Okay, but you can revise it again so that you will not forget this. The formulas are very easy. Then high current ratio, idle asset. Low current ratio is liquidity issue. Proprietary ratio, shareholders fund divided by total assets. Accounting standard relevant for ratio analysis is AS1, disclosure of policies. Then ratio shows quantitative relationship between two variables. Solvency ratio indicates long-term stability. Liquidity ratio indicates short-term solvency. Activity ratio indicates efficiency of assets use. Profitability ratio indicates ability to earn profit. Gross profit ratio decline क्या होगा? Cost will go up and selling price will go down. Net profit ratio rise, better cost control. Working capital is equal to current asset minus current liabilities. High debtor turnover is efficient collection. And last, low inventory turnover is overstocking or slow sales. So that's it. We'll cover the entire syllabus for EPFO. If you are new to this channel, then stay tuned. At the same time, join Telegram as well so that you will get all these PDFs as well as other study material. Also, the first two videos of this series, EPFO 2025, you will find proper analysis of number of questions from each subject. So go have a look so that from whichever source you are preparing, you will be able to focus on the portions which are important and put more emphasis on those portions. So you can have a look, two videos are there on the same channel. So that's it. All the very best and thank you.